Hi, Dr. Dolly. Thank you for everything that you do. I know you mentioned whole life insurance and how it's generally not a good idea for most people. I am 41 and plan on retiring in 8 years. I have been recommended to get whole life insurance as a way of providing an income for myself from when I retire to when I'm eligible to tap into my retirement accounts. What do you think about that? Thank you.
Good question, Ash. Let's be clear in our terminology here. Okay. You have not been recommended to buy whole life insurance. I'd be very surprised if some unbiased person that you paid just for their advice is telling you to buy whole life insurance to cover this need. What is happening is somebody is trying to sell you a whole life insurance policy. And so they learn a little bit about your financial life and they think, well, what angle is going to help me sell Ash a whole life insurance policy best? Well, this guy's a really good saver that wants to retire early. Let's pitch it as a way to solve the age 59 and a half problem, right? That you can't get into your retirement accounts until age 59 and a half without paying a 10% penalty. And, for the unsophisticated, maybe that sounds like a smart thing to do, but it really isn't. Let me explain why. Number one, if you decide to use whole life insurance to pay some of your retirement income needs, it's generally best to do that toward the end of your life. One of the last assets you tap, not one of the first assets you tap. Because remember, when you borrow against a whole life policy, and you can do a partial surrender up to the amount of premiums, that comes out tax-free and just reduces the death benefit. But after that point, you're borrowing against the policy. Now, like borrowing against your house or your car, that is tax-free, but not interest-free. So if you start borrowing a whole bunch of money against your policy at age 50, and then you live another 40 years, you're going to pay a whole lot of interest to get at your own money. So that's a big downside of using it early in retirement. It's far better to use it late in retirement if you have it at all. Issue number two, if you have saved enough money to retire in your 40s, chances are it's not all in your retirement accounts. A whole bunch of it is probably in your taxable accounts. In fact, I can't think of anybody I've ever met that retired in their 40s, that was a physician or other high earner, that had it basically all in their retirement accounts, right? The physician on fire, substantial taxable account. All these real estate fast fire folks, guess what? That's all outside their retirement accounts. And so the age 59 and a half rule doesn't apply. Okay, the third point. There are so many exceptions to the age 59 and a half rule that there are these loopholes so big you can drive a truck through them. Okay, one of the exceptions, perhaps the most notable one, is what they call the SEP rule, substantially equal periodic payments. What that means is if you retire early before age 59 and a half, you can start taking money out of your retirement account without paying that 10% penalty. Okay, if it's a tax-deferred account, you do have to pay the taxes on it. If it's a tax-free or Roth account, you don't even have to pay the taxes on it. You can take that money out. What's the catch? Well, the catch is you can only take out a certain amount per year. How much does that amount work out to be? Well, it works out to be about 3 or 4%, about what you would want to spend anyway, according to the 4% rule/guideline. You do have to keep it up for the longer of two periods, 5 years and until age 59 and a half. So if you start at age 48 or whatever, you've got to keep taking that 4% or so out every year until you're 59 and a half. No big deal, no penalty due. No reason not to invest in a retirement account if that is your goal. So if you've got money to buy a bunch of whole life insurance premiums, you've got money to invest that money in a taxable account and then live on it between the age you retire and age 59 and a half. So this is just a sales technique that this whole life insurance agent is using. If you haven't heard all these sales techniques before, I recommend a blog post on the White Coat Investor blog called Debunking the Myths of Whole Life Insurance. And it goes through all the different ways that these agents like to sell these policies. Try to talk you into using them to pay for your kids' education or for asset protection purposes or for whatever other reason they're trying to talk you into buying it. The truth is the vast, vast majority of people, including physicians, do not need a whole life insurance policy. So you need to have a really good reason to buy it. You need to really understand how it works and still want it. Because the vast majority of those doctors who buy one, especially in their first 10 years or so out of training, end up regretting it, end up surrendering it, end up sending me emails going, how do I get out of this thing? I'm still underwater on it after 10 years. And it just doesn't turn out to be anywhere near as good as they thought it was going to be when they were talking to the person selling it. Meanwhile, the person who sold it to them is laughing all the way to the bank because the commissions on these things are 50 to 110% of the first year's premium. So if they can talk you into buying a policy that's $30,000 a year, they pocketed somewhere between $15,000 and $30,000 to sell you that policy. Now you know why they work so hard at it. All right, hope that's helpful. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.